Okay, welcome everybody. Another podcast by According to Carlo. And today we have a special guest, as always. Mr. Kash Pashutin is here. He is the CEO, and correct me if I'm wrong, CEO of Emblem Developments and First Avenue Investment Council.
That's right.
Okay, welcome, Kash.
Thanks, Carlo.
So let's first start with, first of all, I don't have to be so nice to him because I'm a client. So full disclosure, I'm a client of Kash's. And I guess we should talk a little bit about how we first met. I had investments with another firm that was a friend of ours. Unfortunately, he's passed, but he was a friend of mine and a golf friend from the golf club. And I had my investments with him for several years. And then you purchased the business. And that was sort of my way to get out of that relationship. And I was going to move on. And then I met you. And so I was ready to move on, but I said, listen, out of respect, I'll meet with Kash, whoever this guy is. And I enjoyed our chat. I have to admit, for some reason, I just liked what you had to say. When you meet people for the first time, you either connect or you don't connect.
Yeah.
So I'm not trying to be too patronizing, but I enjoyed our chat.
Thank you.
Even though I'm not one of your big investors, I'm probably just a rounding error for you, but I decided that I wanted to stick around and see what you had to say. And I think it's been a pretty good relationship.
Great.
I want to talk a little bit about, how you got started. And I believe Emblem is something that you came into. That's not how you started First Avenue. You were in the investment counseling business. Tell us a little bit where you started on that.
Yeah. And thanks for the kind words. I know you're not always an easy customer, Carlo. So when you say something, it's very genuine. So thank you. So I started in the business in 1999. So I guess it's been now over 25 years. That was the whole 2000 Y2K. We thought we were going to wake up and our computers weren't going to turn on. But really, I started with, it was actually going into university. And I knew I wanted to do something as it pertained to the stock market, but more so just analyzing companies. As a kid, I was always very curious about what made a business successful and what made a business not successful. And even before I knew it was business, it was that curiosity was always there. My parents remind me that as a kid, we'd go to get me a new bicycle and we'd go to two stores. And I would leave and I didn't care about the bike. I wanted to talk about why one store was really busy and the other one wasn't. And why did they have the old models and this one had the new models? So I always had this curiosity as it pertained to business. And getting into school, you try to match your interest with your study. So I took business. But I wanted a head start. I wanted to learn in addition to going to university in the real world. And so I was working at the bank and there was a brochure. It was a black and white brochure of the investment counselor, the portfolio manager that serviced that branch. And it said, if you want a second opinion on your investments, give him a call. I called this guy, Carlo, maybe 25, 30 times. And obviously never called me back. Why would he? He didn't know me and I didn't really have anything to offer him. But one day he came into the branch. And at the time, it was like seeing Warren Buffett. It was this guy that I saw this black and white photo of every day, called him. And so I went up to him and I said, hi, my name is Kash. And he says, yeah, we've been meaning to call you back. And obviously he wasn't going to. Why would he? And I said, look, I wake up and I think about businesses and the stock market. And I go to bed and I think about the stock market. I would love an opportunity to come and work for you. And I thought I made a pretty compelling pitch. And he looked at me and you got to remember, I was like 17, 18 years old at the time. And so I was frightened. And he looks at me and says, like, how old are you? And right away, I was borderline about to cry. Long story short, he said, look, go to school, get your education, stay in touch, let us know in 4 years where things are at. Well, 4 years, I couldn't wait 4 months. So I thought, in that moment, what is the most outsized offer I could give him that's beneficial for him and not good for me, but he can't say no to? And so I asked him, what are the things you do? Are there things you do in a day that you really don't like doing? And he's named, I get the newspaper and it's nicely folded. I read it. It's a big ball of mess. I have my coffee. It's halfway done. It's cold. So I said, look, why don't I come in and take care of those things for you and you don't have to pay me? And he said, so you want to come in and do the work
Amazing.
and not get paid. And I remember at the time thinking, I don't know how I'm going to pay for university if I'm offering to work for them for free, but I'll figure it out. So I got in there. They gave me an opportunity. I worked during the summer for free. At the time, the rules with the banks were, more flexible than they are now. So they let me work for free. I didn't get paid. And then when school was starting, they said, you're working 15 hours at the bank. We'll give you the 15 hours here to work and we'll pay you that $8, $9, whatever it was. And so as I started university, I was already in the investment management world. And I took an unconventional route in that it wasn't the finish school, prepare a resume and submit it. But I'll tell you, during university, I never worked 15 hours. I worked like 50 hours. So by the time the 4 years were done, I had a very strong understanding of the industry and had built experience in analyzing companies and looking at balance sheets and investing money for families. And so that's really how it started. And today, we've grown from a firm that focuses just on managing investments in the stock market to really having four major verticals. We have our equities business, so we invest in stocks, but really just to take a step back, we call it a pension style approach. And there's four main components. There's stocks, there's private equity. So instead of investing in public companies, we invest in private companies. We're looking for medium to large, well-established private companies that have an opportunity to grow, but need some help. Not even just financial, but the capability of acquiring companies, putting them together. How do you set up the capital stack, all of that. So that's called our Partners Fund. And we have a real estate arm as well. So part of the portfolio allocates to real estate. And Emblem Developments is our sister company that executes on our real estate investments. I founded that business. We got a great team there that comes from the real estate background, and we're very focused. And we've done projects all over. We're about to deliver our 7th building in the last 2.5 years. So we've been very active. It's a 427 suite building in Mississauga. Looks great. It's going to be on time, on budget, and that'll be occupying this summer.
It's amazing. Those 2 towers you built in Cooksville. So that's, it's amazing how there's full circle. I didn't know you until a few years ago, but my mother still lives literally a kilometer away from those 2 buildings. So I would walk by those 2 buildings, the land where those 2 buildings were, every day walking to high school. So, I went to T.L. Kennedy High School at 5 and 10. And so those 2 properties where the building that's being finished right now was where my orthodontist was, in that little office building.
Wow.
That little tiny office building you guys tore down.
Yeah.
So I used to go there for my orthodontist appointments. So it's incredible how that connection is. But yeah, my mother still lives in Cooksville. I still drive by this, and those buildings look great. They look fantastic.
Thank you.
And the first building, I guess the one towards the east, is fully occupied now.
That's right.
And the second building looks like it's almost getting completed.
Yeah, we started the second building about a year later. And so it's being delivered about a year later. So the second building is 427 suites. We've actually started our occupancies as of last week. So occupancy has started, and we'll look to register the building by the end of the year.
Yeah, and it's great for that area. That area really needs those buildings. They're beautiful buildings, and it's really, really good for that area. Before we get on to the Emblem side and discuss a little bit about that, tell us in this environment, and I see you on Bloomberg. I watch Bloomberg, unfortunately, probably too much. Tell us, in this environment, geopolitical environment, this interest rate environment, where are the opportunities on the equity side? How do you determine, where you go with that? Because it's fascinating. You have the real estate side, and then you have the equity side. And I'm always fascinated with how you decide, where you move your clients' money or how you deal with that.
Yeah. Well, and like you said, we have real estate, we have equities, but then having private equity adds a whole nother dimension. And then the fourth strategy, Carlo, and I'll answer your question, the fourth strategy that we've been working on for about 2.5 years now, and it's done. It's going to be live this September. Is called Strategic Income. And what we're doing in that strategy is essentially buying life insurance policies from people that don't want them anymore.
Wow.
So for example, John Smith has a life insurance policy with, let's say, a death benefit of $2 million. And John says, you know what am I paying thousands of dollars a month for this policy? I don't need it anymore. So he calls his agent and says, I want to sell it and or cancel it. And his agent says, well, did you know you could sell your policy? And usually the answer is, oh, wow, that's great, because they didn't know, because only 3% of people in North America know that they could sell their policy.
Wow.
So depending on the age and the policy, that determines how much we pay for it. But long story short, John is happy because he thought he was just going to cancel his policy, and he's actually going to receive some dollars for it. And what we end up doing, long story short, is we will acquire the policy, and we don't buy everything. Our team looks at many policies a month, and we have a very strict criteria, but we will essentially assume the policy. Our fund will continue to pay the premiums, and on the event of death, the fund is the beneficiary and it pays to the fund. So we operate it like a true asset class. What I like about it is, in 25 years of investing, I haven't seen an investment that has no relationship to interest rates, no relationship to the economy, no relationship to the stock market. You can say today, no relationship to tariffs. So it really is a unique asset class, and it really helps. It's the true definition of diversification. So that's the fourth vertical. But just going back to your question of, when we're looking at strategic income or private equity, private businesses, or investing in public companies, the stock market or real estate, how do we determine it? Well, what I would say is that the reason why we have these asset classes in the first place is, when we look back at the tech meltdown, when we looked at the global financial crisis in 2008, when we've had these real meltdowns in the market, and we look at who's weathered the storm the best, it's been the pension funds. And why is it that they've done better? It's the asset mix. If you have $100 to invest and you go to your typical bank, let's say, to manage your money, or even a local financial planner to manage your money, most times they're going to invest it in predominantly stocks and maybe a little bit of bonds. When you look at the pension funds, the three largest pension plans in Canada over the last 50 years have had more than half of the portfolio outside of stocks and bonds. Today, when you look at the three largest pension plans in Canada, OMERS, CPP, teachers, they have about 70% of the value of the plans outside of stocks and bonds. So it begs the question, why is it that if you go see your local financial planner, they're telling you stocks and bonds, whereas your neighbor, who doesn't worry about retirement because he or she has a pension, has a portfolio that has a very different asset mix? And I would say that this is very much a Canada-centric thing. I'm part of a global family office network, and so we meet with chief investment officers from Europe and Asia and United States and different parts of the world. And when you look at the asset mix there, it's a lot more like the pension plans.
Right.
And so Canada, because it is dominated by the banks in terms of investment management, there really is no need for innovation. There's no need for going above and beyond because they control the market. And so as a result, the average investor, and it could be the average high net worth investor, it's not just average in terms of assets, but just most investors in Canada are predominantly stocks and bonds. So having that pension style approach, it really allows you to, I would say, one, reduce the turbulence in the portfolio because you're not living and dying by the stock market sword. I mean, when you have predominantly stocks or bonds, in some years you're eating caviar, in other years you want to eat craft dinner, right?
That's for sure.
So it reduces that. It increases the consistency of returns, and it reduces the turbulence in the overall portfolio. So what I would say is, to going back to your question, how do we decide? Well, the clients that have had the best performance are the ones that actually aren't rolling the dice at the beginning of the year and trying to decide. Having exposure to these different components, they have an uncorrelated relationship to one another. And so at any given point in time, something isn't working that well, but other parts are working very well. And so the net result is trying to bang out that sort of high single digit return, regardless of the environment you're in.
And like our business, your business is still about relationships.
Definitely.
Because I don't have a clue what you've put my money into. I just completely trust. And when I met you, trusted you. Sam, the Sam Asaf, who's your senior advisor. He's been great. You guys have been great. I love the relationship, but I never even ask. I have no idea.
Yeah.
I think Sam says, "Oh, we're going to put some of this into this," and I go, "Okay, whatever," because I'm just a believer in. I know nothing about what you do, how you do it. You've been doing this for God knows how long. I wouldn't question it. Yeah. So it's really about personal relationships, like our business. We try to have relationships with people so they listen to what you say. So again, I have to say that it's been good. It's been great. And I like the fact that you have that diversification mix. Let me ask you about, I don't want to talk about politics because I don't like talking about politics in public, but just what's the real effect of all this, other than the uncertainty that people seem, some manufactured, some not manufactured, some blown up, some not. But this whole issue of tariffs and all the stuff that's been going on, I tend to think that there's been so much talk, so much stuff, but really, what has really happened? Our economy's doing great. Unemployment's fantastic. Inflation's still kind of in check.
Yeah.
There's all this bluster about tariffs. Is it really going to be an issue, or is it just much ado about nothing?
Yeah, it's obviously front and center on everyone's minds. What I would tell you, we're seeing is that if these tariffs go on a prolonged basis,
right,
that is when we're going to see it impede on growth. Because, everyone throws around the tariff word so much, and really in its simplest form, tariffs are a tax.
Yep.
Right. And
Correct.
So it increases the cost of whatever goods you're buying. And so when things become more expensive, we all sort of look at it and say, maybe I'll buy less. And if you can't buy less, then it leaves you with less dollars to buy other things. In terms of the tariff landscape as a whole, our view is that a lot of this is being used as a negotiation tactic, a negotiation strategy to strike a more favorable trade deal with the U.S.
Of course.
I think President Trump would call it a more fair trade deal, but really a trade deal that is going to be more beneficial for the U.S.
of course,
than what they have now. And, in many ways, if you are the president of a country and your job is to represent the best interests of that country, you want to strike the best deal that they can. Now, there's a whole politics discussion we could have of, is he going about it the right way or not? And, obviously we're not doing that today, but really I think the tariffs are rooted in revisiting trade agreements that are in place and looking to improve the terms and conditions for the United States. Will it have a major impact or a material impact on the economy? I think if it goes on a prolonged basis, it will. And not only for other countries, but for the United States as well.
Well, but that would detract from his supporters.
Yeah.
Because if it's good for the U.S., then he's right. But if it's bad for the U.S., he'll be put in check.
Exactly.
And in 18 months, let's face it, 18 months from now, there'll be an election, which could completely impede anything he wants to do. So I find that, the market, again, finds its watermark and just figures this all out. And it's just so much noise. Like in my business, in predominantly residential resales, and the uncertainty, rates are still pretty good.
Yeah.
But it's just this mental blocks that people have. That where's this economy going? Tariff. And, I just don't think it's been that concrete in terms of what it's done to us yet.
Yeah.
And I still don't think it's going to be as bad. Maybe I'm just trying to be too positive because I think Canadians will wake up, and Canadians are doing some great things on how to counter whatever he's trying to do.
Yeah.
So, and I think it's been great that way that Canadians are waking up too, and we're doing really good things for our country.
Yes.
So again, I think Canadians are in love with real estate, and they always have been. I've been doing this almost 40 years. And this is a little bit different than what you and I've talked. Well, I've talked to you about the early 90s, what I went through. One's a little different. But I still think in the end, and I thought this spring would be a nice little kicker, but it didn't happen. But I still think spring of 26, I think we're going to see an uptick in volume for us. Let's just, if you don't mind, I want to talk a little bit about the condo market. It's been a little bit of a struggle for us.
Yep.
You're in the heart of it. Tell me what your strategy is going forward now. I bring you a piece of land and says, hey, Cash, we can build a 50-story building here. What are your metrics in terms of looking? Are you even looking at stuff like that or even considering it? What are the metrics that you would look at?
Yeah, I mean, look, so to your point, the condo market has definitely been soft, and soft is an understatement. And why has it been soft? It goes back to what you were saying. There's just so much uncertainty. And I think part of it is whether investors or buyers are buying resale or they're buying a pre-construction condominium, they're so worried about a variety of different things. But the truth is they don't really know why they're worried.
Correct. I agree with that.
And they're just confused. And, it's, I think everyone is sort of moving forward with a state of, I don't know what I'm doing. Nothing is really intentional right now. And so we're seeing the implications of that. The fact is, for example, on the condo side, the irony of it is that when you're making a decision today to buy a condominium, if it's a pre-construction condominium, how you feel today actually has very little input into the probability of success of that purchase as an investment, because you're not getting the unit for another 4 or 5 years. And so if you're worried about interest rates, if you're worried about tariffs, so what I would say is for buyers, and this applies to resale as well, you sort of have to ask yourself, out of all the things that I'm worried about right now, the things that are holding me back from purchasing or making a decision, how many of them are going to matter 5 years from now or 10 years from now? When you go through that very simple assessment, you realize that almost nothing that you're worried about right now will matter 5 years from now and 10 years from now. But it's today very front and center. So it is dangerous, especially in the pre-construction condominium space. It's dangerous to make an investment decision today, or make an investment decision for how you feel today for something that will come to fruition 5 years from now. Look at the buyers that purchased 5-6 years ago, and you couldn't keep a condo unit on the shelf. Before the building was launched, there was lineups and there was multiple bids, and the building would sell out in a weekend. People felt great. But if you look back, was it a great time to buy? Well, they're closing now and they'll tell you no, right? And when you look back, and if I said to you, Carlo, we got this great opportunity to invest. We have interest rates at the lowest they've ever been. So the odds are when you get your unit, rates will be higher. We're going to deliver this building to you at a time where when you get it, we will have more supply than we've ever had. And prices are the highest they've ever been. And you'd say, okay, Cash, so let me get this straight. I can buy something at the highest price ever, and I'm going to get it at a time where there's more supply than ever. And interest rates will probably be higher as well when I close. Yeah. Okay. That's a great, let me buy. Well, that's what everyone did.
Right.
And the reason is they were making a decision for 5 years out based on how they felt then.
Right.
Today, we have the same thing, but the opposite fundamentals. People feel concerned, they're uncertain. But when you're looking at, for example, the condo space, it's kind of the opposite. 5 years from now, we're going to have the lowest supply we've ever seen.
Well, because everything has stopped.
Nothing's building. On average, if we're seeing 20,000 units come to market, it's very clear. The data is all out there. Urban Nation and other outlets provide it. In 2029, we're expecting less than 2,000 units,
right.
1/10 of the supply.
And to get these buildings started again, overcoming that inertia is huge. It takes time.
You can't just press go and catch up. So if you're not building now or starting to build in the next 6 to 9 months, you can't deliver in 2029. So that number is cemented. That number of 1,900 units or 2,000 units compared to 20,000 a year on average is going to be the case. So you think about buying now, and we always hear this, buy when it's low, buy when people are worried. People don't really often understand why buy when everyone's worried. Well, if you're buying a unit today and you're going to get it at a time where there's 1/10 of the long-term supply for that year coming online, you probably will have a pretty good investment, because there's not much competing against you. Whether you're going to sell the unit, there's not going to be many brand new units at the time, or you're renting it, there won't be many brand new units. Now, when you look at it today, there's a lot of challenges. There's all this supply. So someone's looking at it and say, I don't want to buy a unit today because look at all the inventory and there's assignments and all the challenges. But do you think that inventory, going back to my question earlier, do you think that inventory is going to be a problem 5 years from now? No, it'll be absorbed into the marketplace. So all I would say is, I think whether you're, and it's the same in the resale market. You might have a client that says, we're thinking of upgrading our home. We love, the neighborhood and we want to buy something a little bit bigger, but we're worried about the tariffs. Well, if you're going to be in that home for 5-10 years, it won't matter. Right. The difference is, and I think this is the last point I'll share on this. The other thing too is, it's very costly to wait until you feel good. Because when you feel good, your neighbor feels good and everyone else feels good. And that's when the market, there's a lot more buyers and you don't get to get the same terms as now.
So Cash, if I came to you tomorrow and we have a meeting and I say, Cash, where do you see opportunity? I've got some cash, I want to invest. Where do you see the opportunities going forward in the next, 6 months, 12 months, 24 months?
Yeah. Well, so first of all, what I would say is that anything we're investing in outside of a savings account, you want to take a longer term view, because the best investments can take more than 6 months or 12 months to come to fruition. So I think if you're investing, you want to have a 3 to 5 year time horizon minimum. As I mentioned earlier, we're involved in a variety of asset classes. And so what I would say is, in each of the asset classes, we are seeing some opportunity. It's just different and it depends on the person's objectives. For example, in the private equity side, investing in private companies, when you look at demographics, there's a lot of people out there that have built great businesses and worked at them for 25, 30, 40 years. And they're at a stage now where they're looking at it and saying, well, I'm not going to do this forever. And in many cases, the next generation doesn't want to run the business. And so they're looking for a succession plan. And they don't always want to sell to the big private equity firms. So we see a lot of opportunity in that space. We're talking to different business owners that have built strong blue chip private companies. So
what size, when you say, what's a revenue size of a private company that you're looking at?
There's a range, but I would say an ideal range is if they're doing revenue in excess of 100 million a year. And profit margins net are often sort of 10 to 15%.
Right.
So a business that's doing 100 million in revenue will generate an EBITDA of, let's say, $15 million.
Right.
We would look at smaller and we prefer larger, but that would be sort of a starting point. But again, if we see a business that's doing 50, 60, $80 million in revenue and has a high profit margin and there's a catalyst to growth, that's something that we can get involved with as well. On the private equity side, our model is not to be invested in or own 20, 30 different companies. We want to be involved with sort of half a dozen to 10 different private companies, but also be very actually involved in them to help them grow and get to the next stage. And you can't do that if there's 50 companies.
Obviously in different sectors of the economy for diversification purposes.
Yeah, I think for us, it really, not to oversimplify it, but it really comes down to, do we understand the business?
Right.
And one of the, when you look at, for example, investing, and we talked about opportunities, many investors wrongfully think investing in the stock market is less risky than investing in, let's say, a private company. And it can be, but it's not always the case. Often people say, well, there's a lot more transparency with the public companies. Well, it's true, but depends. It's true only depending on what you're comparing it to on the private side. If you're investing in a small private company that doesn't have very good accounting and is using, an accounting firm that's small, the integrity of the data I absolutely agree, is not at the same level as a public company.
Right.
But if you're looking at investing in a company that does $200-300 million in revenue, you sign an NDA and you have all of the transparency that you do with a public company. And the data that you're reviewing is on the letterhead of the same accounting firms as the public companies at that size. So I think if you're focusing on sort of the mid to large side of public or private markets, I should say, the integrity of the data, the accounting reporting is all at the same governance as level as a public company. I think the difference with investing in private companies is you can go a lot deeper into them. You can actually better understand the business and understand risk. If you're investing in a stock, which we do and we have for 25 years, you're making a decision based on research reports and analyst reports, and you're going deep into the company. But the reality of it is you're not really spending time with management. And if you are, if you meet the management of Apple, you're meeting people that are trained to speak to you in a way that you're going to like what they have to say.
Yeah.
When you spend time with a private business owner, they haven't had that sort of formal coaching. It's a lot more raw and real. But more than that, you can spend time with middle management and understand, do they buy into the vision of upper management? And if they do you think they have the capability? I always joke in private businesses, when we invest, we know the temperature of the coffee that they serve. And it's really just an adage to say that we can go really deep in the company. So I think that, again, not one asset class is superior. They all have their pros and cons. And really the idea of the pension style approach is to build a portfolio that has these different components that you can't get with just one asset class. So in terms of opportunities today, I would say from a demographics perspective, there is some great opportunities in the private company space. It's competitive because a lot of capital is chasing that side of the business. We play sort of, our niche is we're investing in larger companies that many of the private equity firms are investing in. So they're large, they're too large for them, but they're not large enough where the big, the KKRs or the Brookfields are interested. It's too small for them. So that too big for most private equity firms, too small for the mega private equity company firms, we found to be a great spot. So we are seeing opportunities there in the public markets. Look, I think as interest rates come down, so it depends on, are you investing for income or for growth? I think what we are seeing is more and more clients are looking for an income stream as they look at slowing down and looking to have that income stream supplement their lifestyle or other income that they may have. With interest rates slowly going down, that bodes well for dividend paying stocks because that yield, for example, if you buy shares of TD Bank and that dividend that you get, if the dividend is 4%, when you're getting 4% in a GIC, why would you buy TD Bank and take risk on the fluctuation of the value when you can get that 4% from a GIC? And 2 years ago, GICs were at 5%.
Correct.
Right? Today, a 5-year GIC depends on where you buy it, but for many of the banks, it's in the high 2s, maybe 3%. So as interest rates go down, investors have less options of where they can get that yield. And so it pushes them further out on the risk curve. So more money flows into the dividend paying stocks.
Okay, so let's conclude with just your opinion on, you obviously just said it, which is you think rates are going to slowly come down further.
Yeah.
So what rate do you think they'll come down to? How much do you think they'll come down? When do you think that's going to happen? And how do you see that affecting the real estate market in the springtime, or whatever this timeline is?
Yeah. So I think that rates are going to come down more. I think that there is a bit of a divergence between Canada and the US. I think Canada's economy is not as strong as certain parts of the US. The US is like multiple countries in one, right? It's difficult to talk about the US as one country because if you look at what's going on in one state, it's dramatically different than another state.
Yeah, it's incredible.
But you definitely have certain states in the US that their economy is much more robust than in Canada. And so that will help on an average bring up the US and as a result, not put the same pressure to stimulate the economy as Canada. I think that Canada is in a position that they can and should reduce interest rates more than the US, because we need that boost. We need that boost. And when you look at the economy, whether it's Canada or US, what's really important is the consumer. The consumer in a developed economy is 70%, 70 of economic growth, GDP growth. So it doesn't matter what's going on in the economy. If the consumer is spending, the economy is growing.
Of course.
And if the consumer is not spending, and so when you look at Canada, I mean, it's, everyone sort of has their own way of assessing it, but let's face it, consumers are spending less. Whether it's leasing an automobile, they don't want the payment to go up, whether it's going out to restaurants. I mean, you just do a quick survey, whatever your peer group is, and you could see that consumers today are spending less than they were a couple of years ago. So our economy is going to be sluggish. But again, that is often the best time to lock in a long-term asset. For example, in real estate, you don't want the economy to be booming when you're buying real estate, because you're going to pay a lot more. So as rates come down, if you're able to lock in a great rate and buy that home that you can see yourself living in for the next 5 or 10 years, that's the optimal situation. If you're waiting to feel really good and for the economy to be booming, I mean, we were there, right? And you had so many people saying, I can't buy a house. I'm waiting for the prices to come down. I'm priced out. It's just too expensive. Well, they got their wish, and now it's, but I'm worried about buying. Right? So you got to pick your poison. If you want to wait till it feels really good, you're going to pay top dollar. And if you want to feel, or if you want to get a great price, or feel like you got a bit of a deal, this is the type of environment to do it in. In a perfect world, you buy right before it turns, but no one can predict it.
Right. Okay. Well, there's a lot of good info there, Cash. I appreciate that. I appreciate you coming down here to talk to us. A lot of great info. And for those of you listening out there, I want to thank Cash for coming in. Again, Cash Pashutin, from the CEO of First Avenue Investment Council and Emblem Developments. Again, great info, great insight, and thank you again, Cash.
Good to see you. Thank you.